Happy Tuesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Tuesday, December 3rd, 2024. As always, we'll start with the executive summary from today's lead-off morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. Today's key macro question is, what will disrupt the Santa Claus rally, part 2? Our answers are, that could very well be the key macro question for all of December, with the S&P 500 notching its 54th record high yesterday, closing up 27% year to date. Around this time last year, I was claiming to be the most bullish I had ever been in my career. We hope you paid attention to our KISS and Dr. Mo signals since. They would have kept you participating in asset markets to capture the bulk of these uptrends. That is precisely what they're designed to do, which is capture the bulk of uptrends while sidestepping most of the downside. These institutional grade trend following processes rarely, if ever, sell the exact top or buy the exact bottom. If you're cool with these prior three sentences, then 42 Macro Research or 42 Macro is the macro risk management partner for you. Elsewhere, copper is climbing amid news that the Chinese government will start its annual Central Economic Works Conference next Wednesday. At the conference, China's top government officials will codify the nation's economic targets and stimulus plans for 2025. The announcements could be disappointing, but China's stimulus efforts have already disappointed investors this fall. We highly doubt any disappointment will be enough to derail the year-end performance chase we were calling for this summer when bear porn purveyors were busy convincing millions of gullible retail investors to sell the lows. Shame on them. Transitioning to our 42 Macro dashboard, as always, wrap up with a question from our community. This one's not really a question, but I'm going to turn it into a question for the sake of debate. So it says, tariffs. To me, reading the question, it says, to me, it looks like Trump doesn't really want tariffs. He uses that as a bargaining chip because if he wanted tariffs, he wouldn't be saying do this and you don't get tariffs on your goods. This speaks that he is more interested in advantages rather than tariffs themselves. Completely agree. 100% agree with that. Clearly President Trump, going back to his previous administration and, what has been bandied about on the campaign trail. Again, this guy literally is in a different town campaigning every single day for like the past 4 years talking about tariffs. Clearly, his mission is not to, create some significant economic hardship for the U.S. and global economy vis-a-vis tariffs. That's not his goal. His goal is to transfer, units of employment from China, from Mexico, and from U.S. as trading partners to the United States so that we can raise our overall level of total employment and ultimately more likely raise the share of national income that is, currently being allocated to the labor. Now, the problem with that is assuming that China, Mexico, and our U.S. and our major U.S. trading partners, Europe, Canada, are going to sit idly by and allow their economies to deflate while our economy to reflate at the expense of their economy deflating. It seems very unlikely to me that they just go along with the ride and say, guess what? We're so concerned about the threat of tariffs that we're just going to give you what you want with minimum friction and allow this to allow us to sort of basically take it on the chin so that, President Trump can make good on his campaign promises. I'm an American citizen. I'm rooting for that outcome, by the way. I hope that this doesn't go poorly. Doesn't matter who's in the office. I'm rooting for them to do well from an economic standpoint. The problem with assuming that is assuming that, the leaders of China, the leaders of Mexico, the leaders of Canada, the leaders of Europe are going to sit idly by and allow the U.S. to essentially strong-arm them into deflating their economy so that we can reflate our industrial economy. It just strikes me as something that doesn't seem very, assuming that Pollyannish outcome is the base case scenario. To me, that's not the base case scenario. It is a potential outcome. It is a right tail risk outcome that we avoid tariffs and Donald Trump gets everything that he wants in the form of, more U.S. economic exceptionalism at the expense of our key trading partners. But to me, it just seems very unlikely that is the highest probability outcome. Now, again, does this all really matter? Again, we talked about this in the context of our triple S's theme. You have to be concerned as an investor about the size, the sequence, and the scope of, President Trump's, second administration policy implementation. It could be the case that the size, sequence, and scope sort of net out to a generally positive, outcome for the economy and for asset markets. It could also be the case that the size, sequence, and scope, more importantly, the sequence, kind of nets out in a way that could potentially cause some problems for asset markets, just from a sequential standpoint. especially considering where we are in the positioning cycle. So again, we don't have all the answers here. No one has all the answers. Donald Trump himself doesn't have all the answers here when it comes to tariffs and the response of the rest of the world. Obviously, his cabinet doesn't either. So we're all sort of at the kind of at the whim of the most volatile president in U.S. history. Sort of waking up. On Truth Social, we're at the whim of how the leaders are going to respond to this economically. And so there are certainly scenarios that are positive, and we don't want to dismiss those potentially positive scenarios from the perspective of the size, sequence, and scope of policy implementation. But there are also scenarios that are quite negative with respect to the size, sequence, scope, and of policy implementation. So you got to be focused on those three S's. You got to be especially focused on how they're going to impact the 5 cycles that actually matter to markets, which are growth, inflation, policy, liquidity, and corporate profits. And then obviously the positioning cycle acts as an accelerant to any one of those 5 cycles when they inflect, as it relates to those inflections causing problems or causing positive outcomes in asset markets. So this is a lot of moving parts here. This is why folks like me get paid the big bucks, is because we have to think about all these scenarios and ultimately make strong, arduous, and accurate risk management decisions to guide our portfolios to safety on the other side of all this great geopolitical and political change that we're about to experience. So we'll wrap it up there. Darius presenting our macro minute for Tuesday, December 3rd, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.